Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Paul Sweeney. Join us each day for insight from the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. Joining us now from Charles Schwab, Lizanne Sonders. I am really upset this morning about the financial media. OMG, Apple, we're all going to die. I don't know what Apple's going to do. I know it's inappropriate for you to talk about an individual security. But where did we lose looking at support of trend out 1 year, dare I say out 3 years, or for retirement plan investors, a 5-year window? Just the Apple chat of the last 24 hours has been appalling.
Because time horizons have shrunk to, nanoseconds. It's fine to talk about 3 years and 5 years. I think that matters, but a lot of the money in the market trades in a fraction of that time horizon. Right. And, in the case of not just Apple, but Tesla and even Alphabet, it's the China tie. But it's not unhealthy that we're seeing some dispersion, not just among the Magnificent Seven, but churn under the surface that in a stealthy way, there is actually some action and participation down the cap spectrum in other areas. I mean, industrials have broken out, even to some degree financials, and that's not a bad thing.
So we've had, Lizanne, such a great move in the stock market in November, December last year, really driving the market higher. We've actually started the year off very well if you look at the S&P 500.
At the index level.
At the index level. That's where I want to go. So we go beneath. What are you telling your clients, like, if they're saying, I don't feel it? I don't feel it. I know that everybody's telling me the S&P's up 6-7% this year. It rallied hard last year, but I don't feel it. What do you tell them?
Well, it's understandable because let's use the NASDAQ as an example because the extremes here are more significant. But the NASDAQ, notwithstanding yesterday, trading around highs. And at the index level, that NASDAQ has not had more than a 3% maximum drawdown from a year-to-date high.
Right.
But the average NASDAQ member maximum drawdown from year-to-date highs is negative 22%.
Really? Wow, I didn't see that.
So do you call that a bear market?
Well, it's churn under the surface and it's drawdowns at different times. But yes, you've had bear market level drawdowns among the average stock within the NASDAQ.
Jon Tucker, that describes your entire 201k, right?
No, what did you say? It's a duck market.
It's calm, the Michael Caine line of calm on the surface and paddling like the Dickens underneath. Yeah.
So, Lizanne, what do you tell folks? Tom's been long Magnificent Seven. He's been clipping coupons. He's fine. How about the rest of us? Where do we go from here if we haven't been long those Magnificent Seven? I mean, where do we go from here, do you say?
So I think there is money that is itching to find opportunities outside of that small group, also helping to explain some of the dispersion that we're seeing there. I don't think, though, that this is a time you want to sacrifice quality. We've got this recent resurgence again in today's versions of the meme stocks, and that's a little bit troubling, but I would fade that type of move under the surface and lean into quality, especially if you're going down the cap spectrum, because in the case of the Russell 2000, you still have somewhere between 30 and 40% of that index's stocks that are some combination of zombie companies and or non-profitable companies. I don't think we're at the part of the cycle where you want to lean into low quality. There are times where for a trade that makes sense. It's where the leverage is to an upturn in the economy. I don't think we're there yet.
And now, folks, for Global Wall Street, all of you out on Apple CarPlay and YouTube, the question that matters: where is Lizanne Sonders on rebalancing? how do we rebalance without over-rebalancing or selling our winners?
Right.
What's the Sonders process?
Well, rebalancing is more about adding and trimming, not buying and selling. So that's the beautiful component of that discipline. Is it forces
the
us.
operative word they're adding is what people ignore.
It's add low, trim high, distinct from buy low, sell high. And one of the things that individuals can consider doing, which is in contrast to what most institutions, particularly cohorts like mutual funds that have that calendar-based rebalancing final week of every quarter. I think for individuals, and you have to take into consideration the effect of turnover and transaction costs and even things like tax brackets. So this is not a blanket recommendation, but for investors to at least consider what I call portfolio-based rebalancing. Let your portfolio tell you when it's time to do something, whether it's at the asset class level or even within asset classes, as opposed to making that decision on some sort of predetermined calendar schedule.
I don't know. I could buy a 2-year treasury and get 4.55%. Why don't I just do that and get ready for my beach season?
For some investors, that does make a lot of sense. But one of the reasons why, and you guys know my fixed income counterparts, particularly Kathy Jones, that when we talk about considering extending duration, you get that natural question, well, why would I go to a 10-year, 4.2% when I can get something in much shorter duration at a higher yield? But there's the reinvestment risk. Of course, that comes into play. But for many investors, the safety of treasuries, regardless of where on the maturity spectrum, is a wonderful thing right now. And in the ZIRP environment, so many investors were forced out the risk spectrum, either into higher risk segments of fixed income or into the equity market, right. And that's not the case, which is one of the reasons why I think the $6 trillion in money markets could be a little bit stickier. And I don't know that we should consider it some imminent pool of money that's going to jump into the equity market.
You've been right on that, but what is the action of the trillions at Schwab? What do you see people doing on a micro basis month to month?
Well, a lot more money in the safety of areas like whether it's money markets or treasuries. And I think that's a good thing for that component of portfolios that they want to have that sort of high liquidity, fairly low risk. We've been very factor focused on the equity side of things. We have sector biases, but we think even applying it within individual sectors is focused on factors, which is just investing based on characteristics. I got
to squeeze this in. You provided service to the nation with fiscal reviews for one of our presidents coming in 8 years ago. Things have changed. Now it's trillions a month in debt and deficit. Should our listeners and viewers be concerned about the burgeoning deficits?
Absolutely. And I think the investor class is gravely concerned about this. I cannot remember the last time I did a client event or a webcast where the first question wasn't about the deficit and debt. The problem is that's the investor class. I think broader constituents don't seem to care much about it, which is why neither side of the aisle tends to care about it. I think, frankly, we need more adults in the room down in D.C. having this conversation.
We're going to go out with this because Liz Ann sent me a mean note. I did Nickelback one day.
Yep.
Oh,
no good.
She was just like crushed. Liz Ann Sonders, thank you so much. This is the conversation of the day on the arch theory that is out there, which is things are good because the wage growth, after adjusting for inflation, is finally constructive. Jeff Yu with a chart of the week, chart of the month, chart of the first quarter. He's with BNY Mellon. Joins us now. Jeff Yu, thank you. You've got the United States, and we're popping 4% plus wages, and after inflation, there's a real wage. What is it about Italy where they've got wage growth pushing 8%, and they got disinflation, deflation? How good are things in Italy?
Well, just based on the headline numbers, they certainly are looking very good. There were one-offs in place heading towards December, so that generated a nominal wage of 7.9%. But there's genuine disinflation in Italy as well due to lower growth, as you would expect, lower demand. So that buffer is in place right now. And to be frank, it's what several Eurozone policymakers are worried about. They're looking at real wage growth and saying people can still spend. Why are we talking about cutting rates?
Go to the other end of the spectrum in your magnificent chart. I'm going to steal this chart, Paul.
Totally.
And that is, I've got inflation substantial in Japan, and I don't have wage growth. I got an ugliness. Is Japan borderline, as you studied at LSE, 1930s England?
Oh, I think those are going to be very different demographics to start off with and what is driving things. But, net, that's what you're hearing from Japanese policymakers, Japanese lawmakers. They want to see real wage growth, not just a one-off bounce, which is maybe what happened in Italy, but for that to become entrenched. Only then can they consider to raise rates, and they want to generate some inflation expectations to encourage corporates to start paying higher nominal wages and generate real wage growth as well. So basically, that's the ebb and flow of policy right now. And to be frank, and for those of us who think the yen should strengthen in Japan, it is proving frustrating.
So, Geoffrey, we're going to hear from Fed Chairman Jay Powell today. What are the central banks in Europe, what are they saying these days? Are they following the U.S. Fed? Do they have some independent thinking vis-a-vis their economies and their rate structure?
Oh, will totally be independent. But what is the ECB thinking? What is the governing council thinking? It depends on which governing council member you are going to ask, right? There were some members which said March should be, so tomorrow should have been a live meeting. And there are others who question why are we even talking about rate cuts this year. I think that's been brought onto the table for the Fed as well. So very different views out there at this point. But we think Q2, they will need to move on rates. Eurozone economy, look at manufacturing contracting. That is not in a good place compared to the US.
And I know just kind of the expectations here in the U.S., Geoffrey, have been tempered from early this year when maybe 5 to 6 rate cuts were priced in. Now maybe kind of 3 or 4. Has something similar happened in the ECB and the BOE from the market's expectations perspective?
Yes, totally. So triple digits in total cuts were expected in Europe towards the end of last year due to the soft numbers. That certainly has turned around as well. Right now, you're seeing energy prices, for example, contributing positively to headline inflation. And funny that's going on now, given core inflation was too high last year. Now headline inflation is too high. So what are you really targeting? So that's where, going back to my euro dollar, going back to parity core for this year, where we think the ECB will acknowledge that manufacturing really is slowing too much such that they have to move early.
I had some great coverage yesterday, Geoffrey, on the NPC, and basically 3,000 people in a room with the president of China trying to move forward as a communist party. Geoffrey, when you see a Bloomberg headline that says President Xi wants, quote, new productive forces to fit local conditions, what in God's name does that mean, Geoffrey?
If you actually go back to an NDRC document, I believe it was from a month ago, they actually specifically cite the academic who came up with these theories within the Fifth Industrial Revolution and the like. So it really is basically about resilience. It really is about identifying aspects of the economy, technology at its core, being able to generate high quality growth, generate productivity growth, to compensate for things like softer demographics and also potential supply chain challenges as well. That is the plan. Can it deliver growth? And we shall see. But overall, we do think there's upside surprise that flows into China.
Technology's in the news. Ed Ludlow, remember? Is he up yet?
Sure.
I don't know. We'll have to get him on here. But Geoffrey, technology's in the news, whether it's ASML in the Netherlands or U.S. Micron in litigation. The other day, is the Taiwan magic of TSMC, is it at risk?
So right now, China has said in the past that if, let's just say, supply chains are going to be at risk, then China is counting on its own innovative capacity, its own universities, its own education system to start to generate that innovation. And then if we look at what's happened over the last few decades, of course, globalization has helped being able to access global knowledge. But should we also count China out in terms of its ability not being able to innovate and the like? I think that is a big assumption as well, because when sometimes you are forced into a position where you have to innovate yourself back into growth or out of supply chain challenges, that's when sparks tend to happen. So I think globally, this trend towards deglobalization, not just China but everywhere, people sharing less with each other, trading less with each other, that doesn't mean you are going to achieve your strategic objectives. I do think with the electoral season upon us, these are things that policymakers, lawmakers really need to think about.
Thanks for the brief. On Europe with ECB tomorrow.
We had Super Tuesday, but I don't know. As far as Super Tuesdays goes, didn't feel that super to me, but let's check in with somebody who thinks about this stuff full time. Jen Flitton, she's head of U.S. government affairs for Invesco. Jen, we had 15 states and I guess Samoa as well voting yesterday. Key takeaways for you?
Yeah, I think we saw what we expected to see, which was Donald Trump pretty much taking control of the 15 states, all but one, Vermont, which he seems to have lost to Nikki Haley. But the expectation was that after Super Tuesday, Nikki Haley would leave the race, and it looks like we're going to get that around 10 o'clock today.
All right, so where do we go from here for this is going to be a very long campaign because as I remember, the election is not till November. So what do each of these politicians, these candidates, what do they do for the next, I don't know, 9-8 months?
Yeah, this is going to be a really early start to the general election season. And we're already starting to see some of that momentum building up for the policy discussion, right? And we have the State of the Union on Thursday, where I think the president's going to telegraph some of his messaging going forward into this very long general election season. And as we approach the summer, which is the conventions, in July, you'll have the Republican convention there in Wisconsin, followed in August by the Democratic convention in Chicago, and then we'll immediately go into general election season. I think the big question right now is, are we going to see debates in the fall?
Okay, well, I'll go with all that, but I think there's a lot going on beneath. And I know California got Steve Garvey. Remember him on first base?
Yeah, first base. Yes, first base, yeah.
He was ginormous.
Yeah.
And he did a ginormous day yesterday, I guess. But, Jen, what did you learn about, the future of the House off of Super Tuesday? Can you say tilt more Republican likely, tilt more Democratic likely? Which way does that go?
Well, I was watching some specific races, a little esoteric, but in Arkansas, you had some fights for some of your more traditional Republicans against some tight primaries to their right, most notably Steve Womack, and he survived with a nice little cushion there. Looking into Texas, some of those races, you're going to have some additional primary runoff, so that's going to require some spend and money. But I think going into this next election day on March 12th, the Senate is looking really strong for Republicans.
And I believe after Duke takes the ACC and we have Selection Sunday, isn't there a Florida primary out there like within 2 cups of coffee?
That's right, Florida. And last night was Texas. And these are the 2 states that are the most difficult states for Republicans, right? This Senate map is really advantaged for Republicans right now. So, if you think Texas and Florida are their toughest states, that that's not really that tough. While you have the Democrats defending a number of states.
So what if Haley drops out? Come on, we got to justify a road trip down there, Jennifer. Help us. What's going to be the tension of the Florida primary?
Well, look, Florida is a pretty ruby red state now. It wasn't long ago that it was a purple place, but it's a pretty red state. Now, I will say this, you had the Biden campaign sort of telegraphing expanding the map into Florida, which kind of raised a question mark over my head. I'm not quite sure how that's going to happen. I'm really, quite frankly, focused in on these battleground states. After Haley drops out and we start this general election and Trump probably takes the delegates he needs by next week, I'm looking at Arizona, Nevada, Wisconsin, Michigan, Pennsylvania, and Georgia. I am honed in on those states.
I'm enough of a fossil where Florida was actually a battleground state. See ya on that.
Exactly. All right, Jen, the Republican Party, it is the party of Donald Trump. My father, who would vote for Nixon today if he were on the ballot, would not recognize this party. What is the Republican National Committee, the apparatus, the machine, what does it do over the next 8 months?
Yeah, that's a great question. So what we're seeing is Trump really consolidating his support there and turning over the leadership at the RNC. This will now be his RNC. He's putting his daughter-in-law at sort of the front face of the RNC and then moving Chris LaSavita. He's one of Trump's co-campaign chairs and runs the campaign there next to Susie Wiles. He's going in and he's going to be doing a lot of the operational work at the RNC.
Right.
And what they will be focused on are those battleground states and getting really strong captains into those states to carry out the race.
To Paul's really important question, and I take your point, the leader takes over the party. That's the way it used to be. What's the Trump methodology in Pennsylvania versus Republican and name-only Mitt Romney's methodology in Pennsylvania?
Right. It's going to be focused on those suburbs, right? In the Pittsburgh area, in the Philadelphia area, and trying to raise those numbers. He clearly has a lot of growth that he needs to make there with suburban women.
Okay, this has been a great brief. Savita Subramanian, who joins us now from Bank of America. And Savita, what's important about this conversation, if you've made the trek across a year and a half from a more measured, cautious XPX call out to well over 5,000. Describe that trek. What was the path and the process to get to your new optimism?
Yeah, so it was a path that was paved with potholes. I think at the beginning of last year, all of our sentiment models were flashing green because everyone was so bearish on everything. And that was a point at which, we basically saw that the real risk was being underinvested in equities. Then you had, another bank blow up. You had some volatility closer to the end of the year. But I think it was really a year where most of our models were flashing green, except valuation. And
right.
I think, today, we are still constructive on equities, but I would say we're less convicted in that outlook.
Right.
And the reason is, we're at a more of a neutral point in terms of sentiment. And I think the market, kind of optimism has built around themes and stocks.
For Global Wall Street, Savita, what methodology are you using? Are you bottom up, top down? Are you factor based? Is it some magical mathematics out of Berkeley? What's the Savita Subramanian method to look out 18 months?
Thoughts. Yeah, so I mean, it's a lot of different reads. So what we tried to do is come up with different signals that are uncorrelated. So they give you kind of a very diverse take on the market. And we ended up, I remember when I got this job back in 2011, back testing all of the market timing models that we've all heard about, like the Fed model or dividend yields versus bond yields, et cetera. Most of them don't work, surprise, surprise, which is why we're all here. But, what we did find was that if you use kind of different models for different time frames, it seems to work out better. So we have a sentiment model, we have a fair value model. Long-term valuation is probably all that matters. Shorter term, it's technicals. And then over the next 3 months, we look for the probability of an earnings surprise in a positive or negative direction. So that's the suite. But then, of course, Tom, it's more of an art than a science. And each of these models is basically as good as the inputs that you feed into it. So I think where we are today is an environment where our valuation framework for the long term says returns are going to be lower for longer. I think we all kind of knew that. But our near term sentiment and earnings surprise models are telling us that things are actually the direction of the market is more likely to be up rather than down. So I think that's our net message to investors is stay invested. We're not at that point of absolute euphoria on equities. We've seen euphoria build around a few themes in the market, but we think that it could broaden out from here significantly.
So, Savita, I'm looking at your research note here. Realistic bull bear case fair value, 4,100 to 6,500 on the S&P 500. Huge disparity there. What are the key 2 or 3 drivers to push you between, your bull and bear case?
Yeah. So the bull case is really predicated. It's not even that lofty of a set of assumptions, but it's really the idea that, real rates stay lower for longer because of demographics, disruption, all the stuff we were talking about, 5 years ago before COVID. And then on top of that, the equity risk premium actually settles a little bit lower than where it is today because companies are actually focused on high quality growth rather than just levered buybacks and, kind of this lower quality growth that we've seen over the last, the prior decade. So that's one factor. And then the other factor is just the idea that normalized earnings can actually be, we're not necessarily at a point where earnings are peaked and likely to come down significantly. So I think our bull case is actually pretty realistic. And then similarly, the realistic bear case scenario is the idea that real rates settle higher. Inflation isn't controlled. We have and we also have 10-year yields backing up on various drivers. And then on top of that, you have normalized earnings coming back down to kind of the long-term average, which I think is too punitive. So one of the reasons, just for clarification, one of the reasons that we maintained our constructive outlook is that I think that valuation is particularly problematic because if you're looking at a long-term valuation framework and you say the market is expensive today versus 1980 or 1990 or even 2000, the makeup of the S&P 500 is so different today that it's almost like apples to oranges.
How concerned are you, Savita, that a lot of folks tell you there's not a lot of breadth in this market. The Magnificent Seven, however you want to phrase it, there's not a lot of breadth in this market. And a lot of market folks will tell you that's not healthy. What do you think?
Well, again, we back tested this breadth indicator, and it's not necessarily bullish or bearish. So narrow markets can precede strong bull markets with broad leadership. Narrow markets can precede a downturn. There's no real rhyme or reason to just the fact that the market is narrow. I think you have to look at a whole bunch of other factors. What makes me more bullish on the rest of the S&P versus the Magnificent Seven is the idea that when you look at expectations for the Magnificent Seven are pretty aggressive. And we're now at a point where growth expectations are quite lofty. Our analysts think that some of these companies meet or beat those expectations. But if you look at the rest of the market, what's actually interesting to me is that the average consensus long-term growth forecast for a company outside of the Magnificent Seven is the lowest we've seen in 25 years. This is a market where nobody's expecting anything good to happen outside of AI or GLP-1.
And the exuberance meter, we've seen that this week. Savita, I've been dying to ask you this, and this goes back, Paul, to me and Savita in Davos years ago, talking up ESG. And folks, to give you a framework here, Ms. Subramanian was the first to Excel spreadsheet ESG. Just as simple as that. In October, I believe it was, or November, in the FT, one of our heroes, and yours too, Savita, Aswath Damodaran at NYU wrote an essay, ESG is beyond redemption, may it rest in peace. Is ESG investing dead?
Look, I think ESG is like anything else. There are good ways to do it, bad ways to do it. I actually don't even think it is a thing or a concept. It's really just a new set of information that's become formally available to us. I mean, analysts always thought about governance. They always thought about companies with litigation risk around bad environmental practices. But I think now what's happened is it's become a little more transparent through companies telling us more about themselves, which is great. I love data. Who doesn't love data? So, I think that's the crux of it, is that you now have a little bit more insight into the innards of a company beyond just the financials.
Savita, thank you so much. Savita Subramanian, she is with Bank of America. This is the Bloomberg Surveillance Podcast, bringing you the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern. from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.